Is another recession a genuine risk? That's one of the questions I'm going to ask Dr. Andrew Wilson today, because some economists are a bit concerned with the rolling lockdowns around Australia. Talk about how our property markets are handling the lockdowns, the rising inflation figures, and the highest credit figures for quite a while. Looks like we're borrowing lots of money to help support our property markets. If you'd like to keep up to date with what's happening in our property markets, why not subscribe to our YouTube channel and click the little bell icon so you know each time we bring out a new video. Despite a sequence of 13 state or territory lockdowns so far this year, property prices have remained largely unscathed. And even though the rate of house price growth has started to slow, property values increased in all states in July, and they're going to end up with very strong double-digit capital growth this year. But Australia's economy could fall into a second recession in as many years if COVID-19 lockdowns around Australia continue for weeks. Well, that's what some economists are saying. Clearly the most recent lockdowns affecting Sydney, and for shorter periods of time Melbourne, South Australia and Queensland, surely they are going to have a hit on our economy. I've read estimates of these lockdowns costing well over $300 million a day. And that's a high price. And of course, we're not out of it yet, are we? So what does this mean for our property markets? That's one of the questions I'm going to be asking Dr. Andrew Wilson, Chief Economist of My Housing Market and Australia's leading housing economist, in this week's Property Insider Chat. We're also going to talk about the biggest lift in housing credit in 11 years and the latest inflation figures that are scaring some. Hi, Andrew.
Yes, hello, Michael. We're into August now. It seems to me that it was only recently that I was saying, "Can you believe it's February?" And now we're the last month of winter, and spring is beckoning us quite quickly at the moment.
Well, spring is usually a great time for our property markets, but I wonder this year, Andrew, whether things are going to be pushed back a little bit and maybe the hotter times of our markets are going to come in our summer months.
Yes, I think we're getting an extension of our cycle, Michael. That's the response to another impediment, particularly in Sydney. It's not going to, I think, impact the underlying drivers of our market, which, as we know, have been quite strong this year. But it will just act to, I guess, prolong the cycle, prices growth. And that's, of course, because of those restrictions to transactions. But I think we're adapting to that quite well, Michael. Every lockdown, the property market seems to firstly continue to perform at a lower level, of course, but certainly does bounce back quite quickly once those restrictions have eased. And we've seen that at the weekend and with the latest price data, of course, as well. But yeah, so it's onwards and upwards, and it will be interesting to see how our spring market evolves, not just out of shutdown, but also given that we've had very high numbers of property transactions occurring through winter, and winter is usually the hiatus in the market, the pause period, but it has been anything but a pause period this year. So will we see a rebound again from a high level into spring as we usually do? Not so sure we will, but I'm certainly still got lots of optimism in terms of the progress of the markets going forward.
Well, over the weekend, the markets performed very strongly. The auction clearance rates were very high, particularly for Sydney. I think Sydney's got this online auction thing well under control.
Yeah, they've got it nailed, I think, Michael. It was a big weekend in every capital city market. The Sydney listing numbers have fallen sharply over the last couple of weeks. Not a surprise there, because we're now into our fifth week of shutdown in Sydney. So new auction numbers have certainly taken a hit, but they're still sitting at around about normal winter levels, in fact, higher than normal winter levels. And we saw a bounce back in every capital city market in terms of higher listings, higher numbers of auctions, and also clearance rates. All clearance rates were either just below 80% or above 80% in our capital city markets. So there's just really no sign of a winter slowdown. In our auction markets, clearance rates are still high. We could still classify them as boom time. And numbers are at record levels. We're seeing record levels of properties being auctioned month in, month out. And again, July was another record for auction offerings. And I think the interesting thing, Michael, is the Melbourne market bounced back as well. Of course, it's now out of lockdown, and that's what we were discussing before. Markets rebound very quickly once those restrictions eased. And I think a lot of those auction results that we've had during lockdown are influenced by high levels of withdrawals. What we saw on the weekend, which helped to push clearance rates up, was in Sydney and Melbourne, the withdrawal levels fell quite sharply. So we didn't get what we normally see when during shutdown is those vendors that have booked auctions in decide to withdraw their auction before the date, obviously with concern over not just the capacity to find a buyer, but also the capacity to conduct the auction. But withdrawals were down sharply in both Sydney and Melbourne. And of course, that meant upward pressure on clearance rates, and that's exactly what we saw.
Well, while the property markets are performing strongly, what about these prolonged lockdowns? New South Wales is going to go on for a while. They're rolling lockdowns in other states. What's the effect going to be on the general economy, Andrew?
I think we're overstating it again in terms of the predictions of a recession. We've got to understand that we went into a recession last year. It was a bit of a Clayton's recession, really. We had a negative growth over the March quarter last year, but it was just 0.3%. So it was just tickled below the line. And then we had a 7% fall over the June quarter. But most of our capitals were in lockdown during that period. And of course, we've got to understand this is the September quarter data to start with that will be viewed as part of the first, perhaps negative growth quarter. But we're only really going to see a month of New South Wales lockdown contributing to less economic growth over that September quarter. Other states continued to perform well. Even Victoria, that had intermittent lockdowns, didn't have the lengthy lockdowns that affected its economy during the first part of last year. And then, of course, we have the prospect in the December quarter of a revival in the shutdown environments. Hopefully, Sydney will moving all the significant restrictions of lockdown in September. And as we know, the economy will bounce back. So I think it's still a bit of a cheap headline predicting a recession at this stage. I don't think we'll head negative territory in the September quarter or in the December quarter, but we shouldn't be surprised at that because even in very severe shutdown conditions a year ago, we just had a recession with a tickle down in the March quarter and then a significant fall in the June quarter. But we have rebounded quite strongly since then, Michael. And I think the point is also that we'll have a sense of resilience of how to tackle these lockdown environments, which will mean a better performance from our economy, given the constraints that I guess, I hate to say it, but we're getting a little used to at the moment.
Yes. Now, we know the Reserve Bank's been trying to pump up inflation, and recently the annual inflation rate for the 12 months to March, I know it looks back a bit, it was announced at 3.8%. And of course, this is causing lots of speculation in the media. Interest rates are going to rise once again. They keep saying that. But most of the jump was really only temporary, wasn't it, Andrew? A result of one-off effects.
Yeah, absolutely. We knew this was going to happen, Michael. Thankfully, perhaps to some degree, it moderated a hysterical commentary that we were always going to get with that inflation adjustment. That is that we'll see higher interest rates sooner than the Reserve Bank has predicted. Of course, we shouldn't really be talking on the one hand about recessions and then on the other hand about higher interest rates. But, you can't keep a good clickbaiter down, that's for sure. And the media will run with whatever it's delivered as long as it can be a headline. But I do think we've got a credibility gap here emerging. Certainly the predictions, firstly, of higher interest rates have completely disappeared. That is higher than the 2024 prediction of the Reserve Bank. The Commonwealth Bank has predictably backtracked on its predictions of interest rate increases next year. It's using the excuse, of course, of the shutdown and the impacts on the economy as the reason that they've changed their mind. I would have thought, in my opinion, they were going to change their mind anyway. It was really heroic predictions promoting a higher interest rate environment in around about 12 months' time. But in terms of inflation, Michael, we were always going to see that adjustment. A couple of factors involved. Of course, we had prices kept artificially low last year, particularly through subsidised childcare. We also had low petrol prices last year because the price of oil tumbled, and that was a response to lack of demand globally for fuel because of lockdowns. So we normalisation, we've bounced back into more, I guess, typical environment. It was interesting when we look at some of the other cost factors in the inflation data, Michael, that point to the future of perhaps some increases in underlying inflation. And that was that we saw quite a modest increase in the price of building. And that was offset, even though we saw a strong increase in the cost of building labour and materials for housing. That was offset by the subsidies that people were given, particularly the home builder subsidy, of course, which acted to push the pricing costs of housing downwards because, of course, people didn't need the usual deposit to purchase because it was subsidised, that new building. But that's now finished and costs will continue to rise in building. And I think we're only at the early stage of increased residential building costs going forward. And that'll certainly play into underlying inflation going forward. So there are some factors there that we need to watch. But underlying inflation moved to 1.6% annually, Michael. That's still a low number, and that takes out the volatile elements, that underlying measure, the trends mean. But it's still not back to where it was pre-COVID. And the Reserve Bank was concerned about how low underlying inflation was prior to COVID. And this is the point. We're still a long way to get back to that 2 to 3% band that the Reserve Bank accepts as being where it wants inflation to be. In fact, we haven't been above 2% for 5 years in terms of underlying inflation, and consistent underlying inflation pushing up towards 3%. We, of course, have to go back 10 years, and that's when we had upward pressure on interest rates. And so we need a consistent period where underlying inflation is pushing towards 3%. And that is just something that we can't rationalise in the foreseeable future, particularly given that we have issues over our economy in regard to lockdown. But of course, the real point to all this, and this is what we need to watch in the next data that comes out, is incomes, Michael. We can have higher inflation because of these adjustment processes, but the Reserve Bank is certainly not going to increase interest rates if we're not seeing a corresponding increase in incomes if we do get higher inflation. I mean, this is what economists seem to ignore, and I think a lot of them have just got to go back to school or something, because we need to have it in tandem. It's the incomes cost price spiral that is the issue why we increase interest rates, because we have more demand than supply, and that means higher incomes pushing up inflation, which then pushes up incomes. And we may not even move back into that realm ever again, Mike, but we certainly need that occurring. So it's important to look at the incomes data going forward to correlate that with inflation before we start this mindless predictions based on inflation adjustments for higher interest rates.
Well, one of the other things I like looking at is housing finance, Andrew, because I see that as a leading indicator. It tells us what's ahead, often 3 to 6 months ahead, because people get their finance beforehand. And the recent strong growth in housing finance and credit suggests our property markets are going to finish this year very strongly.
Well, I think we've got an adjustment process going on, which is interesting, Michael. And that's firstly, we're definitely seeing affordability decline. Prices growth, while still strong, it has passed its peaks in most of our capital city markets. And that's because buyers are being pushed out of the market because they can't afford to continue to pay higher prices. Of course, a lot of buyer demand has actually been satisfied. That underlying pent-up demand has now been satisfied. So perhaps fewer buyers. But what we are seeing, and there's particular constraints on first home buyers, of course, because they're the first ones to, in terms of buyer groups, to be impacted by higher prices because they don't have the trade-ins that owner-occupiers have to take advantage of higher prices. So they have to rely on their savings and their incomes to keep up with prices growth. And we are seeing fewer first home buyers in the market now. But that decline in first home buyer numbers is being offset by a real surge in investor activity, Michael. And it'll be interesting to see when the data comes out for June, which is coming out shortly, how whether investor numbers are continuing to surge. And that's keeping the market, the loan market, really ticking over. And there's plenty of upside for investor activity, Michael. Investor market share is still at around about a quarter of total residential lending, and its long-term average is about a third. So it's in terms of those average comparisons, it's got plenty of upside for growth. And I think that will be a factor that keeps lending levels rising. Just on affordability, Michael, I have my affordability index for the June quarter, which will be released this week. And I think we'll find just the preliminary findings that there's been a very sharp decline in affordability for owner-occupiers over the June quarter. And that clearly is signalling that some of the heat is coming out of the housing market. And it's still certainly in what you would regard as above average affordability levels, but it's pushing quite quickly to the point where we will see those constraints on buyers as a result of the declining affordability, which is just what we get when prices grow as quickly as they are at the moment, Michael.
Well, it makes sense. Wages have hardly gone
That's
up,
right.
and capital growth has been double digits in
Yeah.
most of our capital cities. So affordability is going to be an issue. Look forward to actually discussing that next week then when we break down what's happening in the market. And maybe we should just finish off by wishing the people in Sydney in particular and other states who are locked down all the best. And remember that this too shall pass and life's going to get normal again, Andrew.
Yeah, and look, the big difference this year, I guess, Michael, compared to last year when we were talking about the economic consequences, is that we have what we might call a lifeline this time, and that's the vaccination. And we know now that the light at the end of the tunnel is high vaccination rates. The government has said once we get to a certain level, then that's the end of lockdown. So we're only talking a few months, hopefully, maybe even weeks, till when we get to that level, and then we can really breathe a sigh of relief going forward, Michael, and hopefully see the back of this very disruptive period we've had over the last 18 months.
I'm sure we all look forward to it, and I look forward to chatting with you next week.
Thanks, Michael.